So this is the introduction to the foreign exchange market. So let's start with the history of the foreign exchange market. Now, trading in currencies dates back many, many centuries. But we're going to start our story in the mid-1930s, just to bring it fairly up to date. Now, back at this time, the UK was the world's leading power, military power, and the British pound was the world's reserve currency. And that reflected Britain's leading economic status. Now, it's always been the way with large powers who have very large shares of the world economic growth. They tend to have the reserve currency status. So what happened at the Second World War, despite Britain emerging victorious amongst its allies, Russia, the States and France, despite emerging victorious at the end of World War II, the economy was completely trashed, as were most of the major economies of the world. And the USA emerged as the major economic capitalist power. So this meant that the dollar was the natural leading candidate to become the world reserve currency. So this is what happened at the Bretton Woods Agreement in 1944. This was an agreement made so that the US dollar would have its importance enshrined in a large agreement that everybody would stick to. So what happened was the dollar was pegged to the price of gold at a price of $35 per ounce. And this was done to stabilize the financial system. So what happened was that foreign currencies, in other words, currencies that were not the dollar, fluctuated in 1% bands around the value of the dollar, and they could be converted into US dollars quite freely. So you had a kind of a fixed floating regime in place, all linked to the price of gold. So we had a lot of stability, and that lasted for quite a number of years. But as we got towards the mid-late 1960s, things started to change. In the States, they had a lot of spending programs, a lot of social programs, which involved very large outlays of capital. And also a lot of dollars were being printed to finance this and also the escalating war in Vietnam. So a lot of calls on the capital of the USA. But the problem was that large amounts of dollars were being printed, but gold was still freely convertible. Dollars were still freely convertible into gold. So foreigners who held gold, who held dollars, for example, could say, "Okay, I'm going to give you my dollars, and I want some gold." So large amounts of dollars could be converted to gold. So the dollar was basically overvalued. So that led to a lot of pressure to devalue the price of the dollar against gold. So large outflows of gold were occurring from the US. And in 1971, President Richard Nixon decided to close the gold window to stem this outflow. So now the dollar was no longer convertible into gold. So this started to see a large sort of a decline in the value of the dollar. And in 1973, the European Economic Community and Japan decided to let their currencies float freely. And from that point onwards, we saw a very large decline in the value of the US dollar and a very large freely floating regime. So now we talk about the size of the foreign exchange market. How big is it in terms of daily turnover, and how does it compare with its peers, the other markets that are out there? Now, most people tend to think that the stock exchanges of the world are most likely the biggest. The New York Stock Exchange, many would say, would be the biggest market in the world, but that is far from the truth. Foreign exchange is the global marketplace for buying and selling currencies, and it's the largest and most liquid market in the world. $5 trillion per day is turned over on the foreign exchange market. So how does that number compare with the other markets I've mentioned? So compare it to the next biggest market is the New York Stock Exchange. Now the daily turnover on the New York Stock Exchange is $22.4 billion. So compare that to $5 trillion of the foreign exchange market, totally dwarfed. After that comes the Tokyo Stock Exchange at 18.9 billion. And way down the list comes the London Stock Exchange with 7.2 billion. So you can see the daily turnover in the foreign exchange market far outweighs the daily turnover of the three next markets combined. So it's absolutely huge. So who participates in the foreign exchange markets? Well, the participants in foreign exchange break down into two main categories. You have the institutional players and you have the retail players. Who are the institutional players? Well, the institutional players are investors in foreign countries. For example, people who buy real estate, stocks, bonds, long-term investments in other countries. And there are businesses who trade with foreign countries who have large capital outlays to inject into different countries, and large capital flows that go back and forth, profits and losses, and lots of different flows that go between different countries. Also, banks and governments are large institutional players, and they borrow or they lend or invest in other countries. So you can see these are the main end users, if you will, of the foreign exchange market. These are the real players of the foreign exchange market. Now we come to a subcategory, which is the speculators. Now, speculators are people who are there just to make profits from movements in the markets. In other words, looking to profit from price changes in foreign exchange rates. So the large speculators are hedge funds and investment banks, and these are people who buy and sell huge quantities of currency, looking to make money over the price changes in maybe a few minutes, a few seconds, a few hours, a few days, whatever the time frame that they trade on. And then we come to the retail players, the retail foreign exchange market. That's people like you and me, Joe Public, who have a small trading account, and we want to speculate on the price changes in foreign exchange. So small speculators, i.e. the public, are looking to profit from those changes in foreign exchange rates. Now, major foreign exchange rates are not as volatile as other asset classes, and they rarely move more than 1% per day. So that makes it a little difficult to make a lot of money in the foreign exchange market, you'd think. But there is a phenomenon or a facet called margin, whereby speculators, they trade on borrowed money. So they borrow money from the broker, they put down a deposit, borrow money from the broker, and they trade a larger amount of money. Now this leveraging up, can sometimes amount to 100 or 200 times the amount of money that they have in their trading account. So you can see that the value of a daily move, for example, on one of the major rates of 1%, can easily be magnified to much larger moves up or down. So very large profits or very large losses can be made. So how is foreign exchange traded? Well, foreign exchange is mainly what they call an over-the-counter market with no fixed location. So you've got basically lots of people trading with each other, mainly electronically, also maybe over the phone, but not on a fixed exchange where, for example, you'd imagine the stock exchange to be stock prices to be traded, or futures, and a clearing house is involved where they transfer the underlying security for the cash to the new owner. This is what happens at an exchange, whereas the foreign exchange market is really over the counter with no fixed location. So these major players, the institutional traders, they use what they call the interbank market. So you're having banks trading with each other, quoting very large amounts of foreign currency to each other and the price. The major banks make markets over the phone or on electronic trading platforms such as EBS, Thomson Reuters. There are others, Coronex, Hotspot, lots of other platforms where people make markets to each other. And the prices quoted are in very large sizes. For example, you might get one bank quote to another bank a price in one particular currency against another in $1 billion face value. So the banks, they trade and settle net amounts between each other. They may trade with each other thousands of times per day. And at the end of the day, they will do a net settlement with each other. Bank A owes Bank B $50,000 because Bank A or Bank B made a profit or a loss of $50,000. So you get this kind of net settlement at the end of the day, and 2 or 3 days down the line, money changes hands based on the transactions which are made. So banks, they trade and settle net amounts between each other. Now, the foreign exchange market also has a section which does involve exchanges, a fixed exchange, and this is where futures and options on the spot are traded. And the most important one, I would say, would be the Chicago Mercantile Exchange in the USA, where there are some very large contracts in currencies where people can hedge and speculate on the current currency markets. Retail traders trade using electronic trading platforms at online foreign exchange brokers. So in a kind of a way that they mirror some of the major players, they can trade on an electronic platform in the sizes that they want to trade. So now let's talk about the structure of the foreign exchange market. So we've got a little pyramid here which shows that at the top of the hierarchy we have the FX dealers, which is basically the interbank traders, the people who make markets to each other in very large amounts. And below that we have other large participants, for example, the longer term investors, and also some of the longer term speculators, for example, the hedge funds. So you have the corporates, and we've got the governments and the hedge funds. These are people who are very, very large, trading very large amounts with each other and also with the major banks. Below that, we have a range of foreign exchange brokers and ECN providers to the retail market, to the retail speculator. And these people get their liquidity from those above, and then they feed it out to those below, people like you and me. So it's a bit like a wholesale market and a retail market where everybody takes a little cut along the way, and the speculator at the end buyer, if you will, probably pays the highest in costs. So now we'll talk about how foreign exchange is quoted. So each currency has got a unique 3-letter identifier code, which is called an ISO code from the first 2 letters. So each of the first 2 letters, the ISO code, represents the country or the block we're talking about. So for the US dollar, it's US. For the euro, it's EU. For Japan, it's JP. For pound, it's GB, and so on and so forth. And it's got the currency identifier at the end. So D for dollar, R for so EUR is for euro, JPY Japanese yen, P for pound, GBP, and so on and so forth. So Swiss franc, CHF, Australian dollar, AUD, Canadian dollar, CAD, Chinese yuan, CNY, Korean won, KRW. So now we're going to talk a bit more about currency pairs. Now, a currency pair is simply putting 2 of those currency codes together. So, for example, if we're looking at the euro against the US dollar, we are talking about EUR USD. That would be a currency pair, the euro dollar, euro against the dollar. Now, a currency pair breaks down into a base currency and a quote or quoted currency, where the base currency always appears first. So the price of an FX pair represents the amount of quote currency required to buy 1 unit of base currency. So here's an example. For euro dollar, EUR USD, euro is the base currency because it appears first, and USD, US dollar, is the quoted currency because it appears second. So EUR USD is how many dollars can I buy for 1 euro? Okay, so if the price, the spot price of euro dollar right now is 1.20, then 1 euro is worth 1.2 US dollars. So the base currency you can see on the screen here, base EUR, 1 euro, quote USD, 1.2. So 1 euro buys $120. Now, just using this to extrapolate to a larger amount, somebody had €1 million and they wanted to buy some dollars at the current market rate, it would simply be €1 million equals $1.2 million, where EUR 1 million multiplied by the euro dollar exchange rate of 120 equals $1.2 million. So when does the foreign exchange market open and when does it close? Well, actually, this is a trick question because there is no official close for the foreign exchange market. It just rolls around the time zones. So when one time zone finishes, when New York finishes, or the US zone finishes, then the Asian zone comes in the next day. So this rolls around all the way through the week until you get to the weekend, when it does actually stop until we get the first prices out of Asia or New Zealand, Australia on the Monday following. So no official close. Foreign exchange markets open 24 hours a day, 5 days a week, most of the days of the year, including most of the national holidays. It tends to be shut for Christmas Day and New Year's Day, but most of the other days it tends to have somebody somewhere is quoting a foreign exchange price. So how does the day start and how does it end? Well, the first prices come out of New Zealand, Australia, and these are usually traded on what they call wide spreads. In other words, the difference between the buy price and the sell price quoted between one bank and another is actually quite wide. So this reflects a lack of liquidity as the first players come in. There are not that many people involved in the market. But as time goes on and more people come in and more time zones wake up and start trading, for example, Japan, China, Southeast Asia, more liquidity comes into the markets, and these spreads, the difference between the bid and the ask price, start to narrow. And that makes it easier and more profitable to be trading foreign exchange. The most liquid period happens as the Europeans come in, followed by North America. That European to US time zone overlap is the most liquid part of the trading day. So price spreads there are usually very narrow, and it's quite efficient to be trading in and out of the market over the European and North American session. And as we get towards the end of the North American session, the global session starts to draw to a close, and the prices start to widen as liquidity falls. And then the cycle starts again for the next trading day. So most brokers use the end of the North American session as the daily cutoff for settlements and reporting at 2200 UK time. So although there's no official close, we've got a kind of unofficial close at the end of the US session, where the brokers do their end of day and statements are sent out. And if anybody has to pay margin amounts or do anything, it's all based on that end of day valuation. Okay, so now let's look at some of the structure of the market and which currency pairs are heavily traded and which ones perhaps are not. So top of the list is EUR USD, no surprise there. That's the cross rate between the euro and the US dollar, the two major economic blocks in the world. So that gets 24% of the volume of the foreign exchange market. So you can imagine that the price spreads, the bid-ask spreads for euro dollar are actually quite narrow. They tend to be some of the narrowest spreads in the market. That's closely followed by, well, not closely followed by, but that's followed by the US dollar against the Japanese yen, which accounts for 13.2% of the volume traded. And then sterling dollar, 9.6%, Australian dollar US, the Aussie, 5.4%, dollar CAD, the loonie, 4.4%, dollar yuan, 4.1%, and below that, dollar Swissy, dollar Hong Kong, euro against the pound, dollar Korean, like that, in that kind of order. So very kind of insignificant compared to some of the top two or three as you go further and further down the list. Now, this list is compiled by the Bank of International Settlements, the BIS, and as recently as 2019. So quite a good authority on the volume of the foreign exchange market. So now we break down the foreign exchange market in terms of category. Now, there are different categories of foreign exchange pairs. You'll hear the term majors, commodity related, and crosses mentioned quite a bit. And the majors is simply the US dollar against the most heavily traded of the other currencies. So the dollar against the yen, the dollar against the pound, the dollar against the Swiss franc, for example, these are what is known as the FX majors. Now, some people have different currencies in there, for example, Aussie, Canadian. Some people consider those to be majors, some don't. But it's just a term bandied around for the dollar against one of the major traded partners out there. Then you have the commodity related currencies. Now, these are currencies which have a strong value linked to a commodity. For example, gold, crude oil, coal or iron ore. So if the economy of one particular country is heavily affected by the price of one of those commodities, then it goes to show, stands to reason, that the currency will tend to reflect the rise and fall of that commodity to some extent in its value. And this is the case for countries like Australia, Canada, Mexico, Norway, Venezuela, countries which have a strong connection to the price of an underlying commodity. And then you have the cross currencies. Now, these are just currencies which are traded against each other, which are not including or involving the US dollar. So important ones would be, as I've mentioned, EUR GBP, the euro against the pound, and also the euro against the yen. The yen crosses tend to be quite heavily traded too, or quite important. So euro yen, sterling yen, they tend to be quite important cross rates. Sometimes other ones come to the fore when there's a particular piece of news going around about one of the economies. So, for example, if there's something happening in Norway, EUR NOK, Norwegian krona, can get the limelight for some time. Okay, now we're going to talk a bit about some of the jargon, because foreign exchange market, there's a lot of jargon about, and in financial markets in general. So let's talk a little bit about some of the jargon that you'll hear around the foreign exchange market. So first thing is the spot price. What is the spot price? So the spot price is simply the current value, the current price of a currency pair. So the market price right here, right now, is the spot price. The order book is a list of all of the open orders currently in the market at a particular venue. Now, this is usually a broker. So it can be an exchange, but in the world of foreign exchange, retail foreign exchange, we're talking about the broker where we have the account. So that broker where you have your account will have an order book where all of the buy and the sell orders will be residing. The bid price, the price at which you can sell right now. So the spot price will be between the bid price and the ask price. The ask price is the price at which you can buy right now. So when you look at the current market price on your platform, you'll see two numbers, the bid price and the ask price. Now, the bid price is the price at which you can sell right now, and the ask price is the price at which you can buy right now. The spread is simply the difference between the bid and the ask prices. At market, this is buying or selling at the current market price, the bid or the ask. So if you trade at the market, you're selling at the bid or you're buying at the ask price. What is market execution? This is simply the occurrence of a trade. So you've bought or you've sold and you've been executed. Your trade has been executed in the market at the market price. Fill price, a fill. When your trade has been executed, it's known as a fill. If you leave an order in the market and it gets executed, you have been filled at your price. Limit order. A limit order is an instruction to buy at a lower price than spot or to sell at a higher price than spot. In other words, at a more advantageous price than the current market price. So if you want to sell, you're trying to sell at a higher price. If you want to buy, you're trying to buy at a lower price. A stop order is the reverse to a limit order. A stop order is an instruction to buy at a price higher than spot, or it's an instruction to sell at a price lower than spot. So you could say that a stop order is a price at which you're selling, which is less advantageous than the current market price, or a price that you're buying, which is less advantageous or more expensive than the current market price. But for reasons I'll explain later, you will have very good reasons to do this. Now we'll talk a little bit about pips. You'll hear pips mentioned quite a bit with regards to foreign exchange prices. I've made 50 pips today. I've made a profit of 20 pips. I've been stopped out. It cost me 20 pips. People use the term pip quite a lot. So what is a pip? So yeah, it's a term that you will hear frequently in the foreign exchange markets, and it simply stands for point in percentage. For most FX pairs, 1 pip equals 0.0001. And that's for currencies quoted with 4 decimal places. And that's most of them. Most of the currencies that you'll see are quoted with 4 decimal places. But the exception to the rule here is anything that involves the Japanese yen. So the Japanese yen is quoted in 2 decimal places. So 1 pip on the Japanese yen equals 0.01. So just to show you a couple of examples, euro dollar moving from a price of 120 to 120.05 is a 5 pip move. Dollar yen moving from a price of 103.37 to 103.27 is a 10 pip move, because dollar yen has gone from 103.37 to 103.27, so a 10 pip move. So obviously when you're trading, it's good to know how many pips you're risking or trying to make for profit. Another term you'll hear bandied around, perhaps not quite as much, is big figure. What is a big figure? Well, a big figure is simply 100 pips. So if you're up 100 pips on a particular trade, you could say you're up 1 big figure. So if euro dollar is trading at a price of 112, 2, I've marked in red there, is the big figure. So a move from 112 to 113 is a 1 big figure move on euro dollar. For another example, sterling yen, if sterling yen is trading at a price of 126, 6 is the big figure, 6.00. A move from 126 to 130 is a 4 big figure move. What is a lot? Lots are used in the retail foreign exchange market as a term for the size you are trading. Now, compare this to the interbank market, where traders tend to be quoting in terms of face value amounts. So, for example, before we were talking about maybe quoting in prices of $1 billion to each other, in the retail foreign exchange market, the prices will be quoted in lots. So, for example, you might be buying 0.5 lots or 2.2 lots, that kind of thing. Now, lots break down into standard, mini, and micro. Most of the time, you'll be dealing in standard lots, which equate to 100,000 units of base currency. A mini lot is 10,000 units of base currency, and a micro lot is 1,000 units of base currency. So, as an example, euro dollar again, one standard lot, represents 100,000 euros worth of face value. So if I'm buying 1 lot of euro or selling 1 lot of euro, I'm selling the equivalent of 100,000 euros of face value. Now, the value of a 1 pip move on a 1 lot position will depend on whether the dollar is the base currency. If the dollar is the quoted currency on 1 standard lot, a 1 pip move equals $10. So we've got calculations here which kind of prove that basically a 1 lot position, a 1 pip move equates to around $10. And it depends on whether you're trading the dollar as the quoted or the base currency. And it's not that important really, I think, to know where this calculation comes from, just to know that if you're trading 1 lot, you're going to be making each 1 pip move will be of a value of not too far from $10. And just to show you the examples there, where the euro against the dollar and the sterling dollar, they both come out at $10 per pip. And examples where the dollar is the base currency, dollar yen and dollar Swiss, they come out at $8.85 and $10.30 per pip. So not a million miles away from $10 per pip on a 1 lot position. But obviously you will need to know the exact amounts for your risk control. So now we're going to look at the order book. We mentioned that before. What does the order book look like? Okay, so this is a standard broker's order book. So what you can see on the screen is in the middle of the screen, in the square box, you can see the bid-ask price, euro dollar, for example, 119.99 / 120.01. So what we have here is the spot price, 119.99 to 120.01, the bid price, 119.99, the price at which you can sell, and the offer or the ask price, 120.01, the price at which you can buy. Top left, you can see the bid-ask spread there, 119.99 to 120.01, and you can see the spread, the difference between the bid and the ask price is 2 pips, 0.0002. Okay, So above the square box in the middle, the bid-ask price, you can see the ask prices above the market. So you can see the prices above the current market. So on offer at a price of 120.01, 02, 03, 04, you can see the different sizes on offer at those prices at this particular point in time. Now, obviously, those numbers will be changing all the time because people will be withdrawing their offers or adding new changing their sizes, that kind of thing. Below the market, on the left-hand side, you can see the prices below the market. So 119.99, 98, 97, 96, 95. And you can see the quantities that people are willing to buy at those prices if the market goes down to those levels. So the market's constantly moving, obviously, and as the market goes up and down, the offers and bids will be filled as the market touches them at the prices at which they are in the market on the order book. Sometimes you might get a situation where the market maybe briefly touches one of those price levels and doesn't fill all of the quantity there. So let's say, for example, the market is right now just testing 120.01, and then it falls quite sharply from there. It might have filled only 500,000 at that price, leaving the other 500,000 yet to be sold. So then the seller of the other 500,000 has got a decision to make whether to keep the offer at 120.01 or to lower the offer or to withdraw the offer. It's up to them entirely. Okay, so now we'll talk a bit more about leverage and how do traders, retail traders, make these small swings in the foreign exchange market. How do they get them to magnify so that they can make or potentially lose larger amounts of money? Okay, well, foreign exchange is quite unlike the stock and bond markets, which tend to require large capital outlays to trade them. It's a little bit like buying a house where foreign exchange can be traded with borrowed money. But instead of the bank providing the money to borrow, it's the broker that provides the money, i.e. the leverage. The broker lends the client the money. So the way it works in real estate is, let's say for supposition, there's a house on offer for £100,000 and you want to put down a deposit and the bank says, give me 20%. You put down your 20,000 deposit and your leverage on the 100,000 purchase price is 5 to 1. Okay, so now let's say for supposition the property rises in value. It rises in value by 50% to 150,000 over the course of a year. So your profit in sterling terms, in monetary terms, is 50,000. So you've made a 50% profit on 100,000 investment. You've made 50,000. But wait, you've only deposited 20,000. So your real gain is actually 250% because your initial investment, your investment is only 20,000 and you've made 50,000 on it. So you've made a 250% gain. Now that is the power of leverage working in your favor in the real estate market. Let's say for supposition that instead of buying the £100,000 house, you bought a small apartment instead for 20,000. You still made 50% on the investment because all the properties went up in the same amount. But in this case, you only made 10,000. So you can see the difference leverage has to your portfolio, to your investment, in terms of magnifying those percentage gains. Now, in the foreign exchange market, leverage is a double-edged sword because obviously it does magnify those gains, but also it magnifies the losses. So you can imagine a situation where, like the real estate example, you made a profit of 50,000 on a 20,000 investment, but what would happen if the market went down by the same amount? Your 20,000 would be wiped out. So it makes a lot of sense to employ a very sound risk management strategy and to be very careful and cautious when it comes to the amount of leverage that you use trading foreign exchange. Okay, so let's talk a bit about leverage here and how much margin is required to for the leverage that you're going to take. So leverage 1-to-1 simply means that you put up 100% of the amount that you're going to trade. So if you're trading a one lot position, i.e. 100,000 face value, you need to put up $100,000 or pounds. If leverage is 2-to-1, then you're putting up 50% of the margin. So you're putting up 50,000 to trade a $100,000 position. Leverage of 5 to 1, that comes back to this example from the real estate, is 20% margin. So 5 to 1 leverage, you're putting down 20% of your 100,000 investment, £20,000 or dollars. 10 to 1, 10%, 10,000. 50 to 1 leverage, 2% margin required, you're putting down 2,000 to control a position size, don't forget, of 100,000. 100 to 1, you're only putting down 1%, i.e. £1,000 or dollars, to control that same $100,000 position. So you can see you can gain exposure to some very, very large price swings for the value of your account simply by taking on a lot of leverage. Now, this can be a good thing, but also it can be a very bad thing. And as I mentioned before, risk control is key. And that concludes this presentation, the introduction to foreign exchange. I'd like to open the floor to some questions.